Hey, good morning. This is Meir Valensky with Driving Markets. Driving while talking about markets. And there's a hell of a lot to talk about today. And let's look at what was driving markets last week and what will be likely to be driving markets in the near week coming. Okay, so last week was all about interest rates. The US at the last meeting on Tuesday, Wednesday, the Federal Open Market Committee meeting, the Fed Central Bank meeting in the US increased interest rates by 25 basis points. And their statement post meeting was that it looks like they can see disinflationary pressures coming to light in the US, and that sent equity markets flying through the roof. The markets went up on Wednesday and Thursday, and of course Meta, Facebook, came out with results. We're going to go into that in a second. Then on Thursday, the UK raised interest rates by 50 basis points, and the ECB, the European Central Bank, also raised rates by 50 basis points. A slight difference between those two rates as follows. As far as the UK is concerned, Andrew Bailey, who I'm not a big fan of, is a complete and utter waste of time, seems to be a failure, but seems to get jobs that pay millions of pounds a year for someone to fail. So the more you fail, the more you get paid. Side point, that's my own personal opinion. As far as the UK is concerned, he believes that inflation is going to crash in 2023, and this is more or less the end of the interest rate cycle in the UK. That sent the pound tumbling because there's nothing for the pound to rise or to look forward to, as if with no further interest rates coming in the UK. I think that's completely wrong, and I think the pound is going to go well up to 125, 127, even to 128, 129 throughout 2023. The pound looks pretty undervalued. As far as Europe's concerned, Christine Lagarde said they raised interest rates by 50 basis points. They'll do it again in March, but there was no guidance whatsoever to further interest rate rises in Europe. There will be more interest rate rises in Europe, and therefore the euro came off. Going back to the US, Meta came out with better than expected results. Meta's Facebook's parent, etc. They came out with better results than expected, and they came out with a share buyback program. And that share buyback program boosted the stock over 23% in one day on Thursday, which to me was absolutely ridiculous. So Meta is only now down 50% from 2022. However, this year, I do see huge recessionary factors coming in and more contracting of the advertising revenue. So overall, I do see Meta floating down to around about the 100 to 120 level throughout 2023. I don't see it going much higher than that. Now, everything was rosy and everything was happy and everyone was happy with interest rates. Bond prices dropped, the dollar dropped, equity markets were rising until last Friday, the NFP, the non-farm payrolls, the US employment number came out. They were expecting around about 185 to 187, 185,000 to 187,000 jobs created. However, the number came in at 517,000 jobs were created in January. That is huge number, well out of sync, well above expectations. That sent bond yields through the roof. Bond yields shot up, the dollar shot up, and obviously further expectations that the Fed now will have much more aggressive interest rate rises in the near future, which is what has been said on driving markets non-stop, came to fruition. Equity markets dropped, and as a result of that, all of the excitement from the Wednesday evening FOMC statement was washed away, with the non-farm payrolls coming in at 517,000 on Friday. So let's just get clear where we're at. What exactly is the issue? When you've got full employment, you're going to have wage inflation. However, the wage inflation that was reported on Friday was steady at 4.4%. However, as you're going to have rising employment and you're going to have a shortage of staff, which is what's happened since the pandemic, since Corona, you're going to have a higher demand by employees, by workers, by staff to get a higher wage. And that's going to concern the Fed in the US, because if wage inflation rises, they're going to have to increase interest rates even further to dampen down the overall undercurrent, the flame of inflation on the retail side and on the wage inflation side. Remember, when you've got full employment, you're going to have full consumer spending or higher consumer spending because people are going to feel more secure in their jobs. So there's a high demand for labor. If there's a high demand for labor and the labor is fully employed, then they'll go out and spend the money, and that will add further to retail inflation. So I've been saying all along, contrary to popular opinion, contrary to all the analysts and the traders and the experts on Wall Street and in the UK and in Hong Kong, the inflation is going to rise globally, in Europe, in the UK and in the US, Canada, Australia, etc. Why? Based on full employment, based on higher consumer spending. So even though you've seen recently inflation taper off and all the economists are talking about a lower level of inflation, I do believe that we're going to have actually a rising inflation in 2023 with full employment and full consumer spending. Okay, that's how I see it. Now, if that does come to fruition, you're going to see a lot more aggressive rate rises in the US, in Europe and in the UK. Remember, I've been calling for 6.5–7% interest rates in the US since last year, and that's been contrary to everyone's opinion, where in the beginning of 2022 I said rates are going to rise 3.5% to 4%. I was laughed off the stage. Everyone said you're absolutely crazy, maximum 1%. This year I do believe rates are going to go to let's taper it a bit, 6.5% to 7% in the US, and in the UK you're going to see easy interest rates at 5.5% upwards. As far as Europe's concerned, you're also going to see 5.5% interest rate throughout 2023. So you've got a mixed bag of numbers and a mixed bag of economic numbers that's driving markets, and everyone is all over the place, not sure which direction we're going in. Talking about cryptocurrencies, I've got to mention cryptocurrencies. Charlie Munger, who's the right-hand man of Warren Buffett at Berkshire Hathaway, has called for cryptocurrencies in the US to be banned. Now, they've been banned in China, so if they're banned in the US, you'll see cryptos and Bitcoin will go down to around about $500 a coin. Would that be the time to get back in, considering the US is one of the biggest markets? So if the US was to ban cryptocurrencies, then what would happen to all of the cryptocurrencies? They'll probably be flattened out, and there'll be a race for safety, and there'd be a massive sell-off. So all the exchanges would not be able to cope with the selling. Their liquidity would be completely destroyed, and they'd probably end up going bankrupt. Take that into account, because even though it's only a statement from Charlie Munger at Berkshire Hathaway, if it does happen, then you could see the decimation of the cryptocurrency sector. Going on to foreign currency, foreign exchange, all those traders who trade FX, you've got a slight upward trend now of the dollar since Friday. I don't think that's going to break it upwards, but if it does break upwards on the DXY, then you're going to see weakness in the pound, euro and the yen. Saying that, the pound, I do believe, somehow is going to get stronger, because I do believe that even though you've got interest rates at 4% in the UK, I think overall the economy will resuscitate itself. You've got GDP out next week, this week in the UK. That'll be an interesting one to watch, see if they're going into negative GDP or they're still positive. If they're positive GDP, then expect the pound to go up even further. As far as the euro is concerned, the euro is anticipating more interest rate rises, so therefore it's going to stay steady against the dollar, about 108.5, 109. Remember, I called it down last year all the way down to 95 when it was running last year, and there was a complete disaster when interest rates were going up in the US and they were not going up in Europe. So this year I am calling it back down to par, 1-on-1. I think Europe is in a shocking state. Inflation is much higher than stated, and it's not as strong as the US. The US is a very, very strong economy. Overall, Apple also is going to be under pressure. Came out with poor results for the first time in 17 years. Interesting how those shares only dropped 2% on poor results, where Meta came out with good results that went up 23%. So you can see the leniency of the market. What they're trying to do is they're trying to push the market higher. I've said that already for the beginning of January. The traders want this market to go higher, and they're disregarding bad news, and they are favoring all the good news twice as much as they're disregarding the bad news. So any good news, markets are going up and going north. Regarding those fans of Tesla, big fan of Elon Musk. I think it's probably gone too high too soon. It looks like it's going to come off to around about the 140 level. Keep an eye on Tesla. Also, Amazon is going to be under pressure again, probably going to go down to around $75 a share, those who are traders in Amazon and Tesla. That's more or less it from Meir Walensky at Driving Markets. You can subscribe, you can share, you can also follow me on TikTok and on Instagram. Have a good day.